If you're similar to most people, you may have formed certain undesirable money habits. However, mastering these crucial concepts at an early stage can set you on the path to wealth. Learning these concepts at a young age can significantly increase your chances of achieving financial success, while those who do not may continuously face difficulties. It's imperative to grasp these important money concepts early on and make sure to stick around until the end for a game-changing concept that will transform your perspective on money. Whether you're interested in personal finance, investing, or just wanted to learn more about money, make sure to subscribe to our channel and hit the like button if you found this video helpful. Let's work together to boost your budget and take control of your financial future. Net worth is a useful measure of your financial health, as it provides valuable insights into your financial situation. Essentially, it is the sum of all your assets, including bank accounts, retirement accounts, and other items of value minus any debts you owe. Tracking your net worth from an early age and monitoring any changes can be highly beneficial, as it allows you to track your progress over time. Even if your net worth is currently negative, keeping track of it can help you see improvements year on year, which may not be as visible on a day-to-day basis. Inflation is not just about the decreasing purchasing power of the dollar. There are other factors to consider. As the price of goods rises, the dollar loses its value, and after 1 year of inflation at 5%, the dollar is only worth 95% of its original value. In about 14 years, the value of a dollar is cut in half. It's important to keep in mind the effect inflation has on your income when negotiating your pay. Even a 5% pay adjustment doesn't necessarily mean an increase in pay, especially when inflation is at 5%. Leaving cash uninvested in a bank account means it's likely losing value to inflation, and a savings account that pays 3% interest when inflation is at 5% means you've lost 2% of purchasing power over a year. This is not significant for small amounts of money over short periods, but something to consider over extended periods. In terms of where to invest your money, it's important to consider liquidity, which refers to how easily and quickly you can access your funds. Cash or money in a bank account is highly liquid since you can access it easily and at no cost. However, retirement accounts such as 401k or IRA have limited liquidity since they're designed for long-term investments, and you may incur fees if you withdraw early. Additionally, investments that are subject to fluctuation in value may result in losses if you need to withdraw early. While investing is important, it's crucial to have adequate savings in place so you won't have to liquidate investments unexpectedly. Understanding interest is crucial when it comes to saving and borrowing money. Earning interest on your savings means your money is working for you, which is beneficial. However, when you borrow money, you must pay interest to the lender for the ability to use their money. Whether paying interest is good or bad depends on the situation. For instance, paying low interest rates can be beneficial if it allows you to generate more income than the interest you're paying. For example, borrowing money at 5% interest to purchase a rental property that will provide a 10% return on your investment is a good deal. Similarly, financing a car at a 0% interest rate and investing the lump sum instead can also be beneficial. However, paying high interest rates is irresponsible and should be avoided. Compound interest is a powerful tool for building wealth that grows exponentially over time. As Einstein famously said, "Those who understand it can earn from it, while those who don't end up paying for it." With compound interest, the interest you earn on your investment also earns interest, leading to significant growth over an extended period of time. By utilizing this concept, you can build a substantial retirement fund without needing to save millions of dollars. If more people understood and utilized compound interest, they could start investing even small amounts of money consistently to benefit from its incredible potential. It's important to understand that market crashes or bear markets, where stock prices drop by 20% from their all-time highs, are a normal occurrence and shouldn't trigger panic selling. Investors should expect these situations from time to time and be aware of them before investing significant amounts of money. Since 1928, The S&P 500 has experienced 22 drops of 20% or more, with an average of one happening every 4.5 years. While it takes the market an average of 388 days to recover from a bear market, it's important to remember that these situations are not unusual and don't indicate the end of the world. If your goal is to build wealth, selling everything in a panic is usually not the best course of action. When it comes to investing, it's important to know your risk tolerance, which refers to your ability to handle fluctuations in the market. For instance, some investors feel comfortable taking on higher risk and might view a market crash as an opportunity to be more aggressive with their investments. Others may be more risk-averse and avoid investing altogether. However, risk tolerance is not solely based on emotions, but also on factors such as age and future earnings. Too much risk can lead to significant losses, while too little risk can hinder the benefits of compound interest. Considering that the S&P 500 drops by 20% or more approximately every 4.5 years, it's important to find a balance between risk and potential rewards. Target date funds or S&P 500 funds could be suitable options to strike that balance. The concept of the time value of money suggests that money today is worth more than money in the future because it has the potential to grow and compound. When you have money today, you can either spend it or invest it to grow. Investing money can result in a much larger amount that can provide for you in the future. For example, investing $100 in the S&P 500 for 30 years with a 10% average annual return would be worth over $600 even after adjusting for a 4% inflation rate. By understanding this concept, you'll be more cautious before making unnecessary purchases. These fundamental money principles are not difficult to understand, but it's better to learn them early on so that you won't regret not knowing them in the future. Thanks for watching. If you have any questions or wanted to learn more about finance, leave a comment. And don't forget to subscribe to the channel for more simple finance tips.